Hi there, everybody. Thanks for listening to the AFSA Extra Credit Podcast. A little bit of a different program this time. We're joined by Celia Winslow, Senior Vice President of AFSA, and Tom Durkin to talk about the CFPB Taskforce Report. We brought the two experts together to answer a couple of questions. Tom Durkin is specialized in the economics and regulation of consumer financial services in the federal government as a senior economist at the Federal Reserve Board, in the academic area as associate professor of finance at Penn State, and in the private sector as a former chief economist at the American Financial Services Association. And now I bring you Celia Winslow in conversation with Dr. Tom Durkin.
Thank you, Dan, and welcome to all our listeners. We're very pleased to have Dr. Tom Durkin with us today, talking about the Task Force on Federal Consumer Financial Law. The CFPB put this task force together to examine the existing legal and regulatory environment facing consumers and financial services providers. And we're thrilled to have one of the members of the task force, Tom Durkin, with us today to talk about it. Specifically, this podcast is going to focus on small dollar credit. So to start us off, Tom, could you give us a brief summary of what's in the report about small dollar lending?
The task force, as you mentioned, was appointed by the CFPB early last year, but it really was designed to look at consumer credit broadly and also other consumer financial services, really to mark the 50th anniversary approximately of the National Commission on Consumer Finance that did something similar back around 1970. And even the National Commission on Consumer Finance came about 50 years after the Russell Sage Foundation had looked into small dollar lending as well. And so it's really 100 years since the beginnings of small dollar lending in a regulated environment. And so it seemed like time to look at many of these questions again, as I say, following up on the National Commission that was 50 years after the Russell Sage Foundation, and now another 50 years have passed. The task force report actually is in two volumes. There's a volume that has a lot of discussion of background and analysis and economics and legal framework and so forth and so on. It's a considerably hefty volume and intended to be that way as a source for not only our recommendations, but for background for people who want to look further into questions of consumer credit. In the first volume, chapters 3, 4, and 5 actually look very considerably at small dollar lending. Chapter 3 concerns with the demand for credit, why people use credit in the first place, who uses credit is discussed there as well as in chapter 2. But just the basic economics of consumer credit and why people use credit is, we think, an important question to look at. And then how that extends to not only to uses of large amounts of credit, but to smaller amounts too. And that discussion then moves into chapter 4, which is focused especially on the costs of providing credit, including small dollar credit, and traces some of the findings of the National Commission 50 years ago and how they compare with findings today. Then the report moves into chapter 5, which is more specific to small dollar lending and looks not only at installment lending, but other kinds of lending, including pawn lending and so forth, that have become widely known in more recent years. So anyway, I'm talking now about a fairly extensive discussion here of going on 200 pages. And also the task force has some recommendations, and its recommendations volume is volume 2. And there are a couple of recommendations that concern small dollar lending. I just might read one of them here because you might be particularly interested in this one. It's actually your recommendation number 94, and it says states should exercise caution when setting interest rate caps when implementing regulations on small dollar credit loans. States should carefully consider the negative impact on credit availability when considering further regulations. Preferably, interest rate caps should be eliminated entirely. Now, no recommendation that the task force makes has any implications for law or anything. These are just recommendations based upon analysis and so forth. That particular recommendation that I mentioned, I think, is interesting in itself because really it very closely parallels recommendations that the National Commission on Consumer Finance made in 1972 and that the Russell Sage Foundation made in 1916.
Well, Tom, I found those chapters that you mentioned fascinating and a great history. And for anyone that's interested in consumer finance, particularly small dollar, or even more importantly, anyone that's looking at regulating small dollar credit, it should really be mandatory reading. One of the things that I hadn't really thought about before, even with my now several years experience in the consumer finance industry, was the way that the task force authors wrote about the credit life cycle, borrowing when you're younger, and then lending when you're older. Could you explain a little bit about that life cycle that the Taskforce report lays out?
Yeah, the life cycle idea is something that ultimately results from empirical analysis that people who have studied credit markets and other areas of economic behavior have found that certain things follow a pattern across consumers' life cycle. So, for instance, credit use is more likely in earlier, younger years when people don't have as much in the way of assets, when their income is a little bit lower than maybe they're projecting that it'll be later. And when they haven't had the opportunity yet, length of time on the job for their income to rise or for them to undertake the necessary saving to purchase the kinds of assets that make life better for people. And so life cycle is an idea that results from just simply looking at what people do. And you see that they behave in a slightly different way over their life cycle, over their lifetime. But it's not the only thing that we might look at. I mean, for example, education is another one where people generally have their gain their educational background at an early stage in their life cycle. And then later, as they're older, they're in the workplace, they tend not to spend as much time on education, but neither of these correlations is perfect. I mean, young people use credit, but also old people. It's just that credit is a more frequent occurrence among younger people than it is on older. And so there is a difference across the life stage or life cycle, as we talk about. Same is true with education. It doesn't mean that older people give up education or that there's not lifetime learning for many people. Education tends to be earlier in the life cycle, life stage, and later a little bit less in the formal education as people use that education and the experience that they gain on their jobs to presumably get better at their jobs and how they manage their life over time. Another one is saving. Saving is related to credit use, but it's not the same thing exactly. Saving is another use of income, but it tends to be greater in later life stages than it is in the earlier stages, which are more given over to spending and acquiring the assets that people need in their lives. So saving tends to take place a little bit later in age, and in investing, then people who started out as extensive credit users tend to use less credit over time and to put aside more funds in the form of cash and financial assets that they use in the form of investment. So anyways, I say the life cycle idea is an empirical generalization from experience that we've seen as economists that we've seen. And one of the things that has a life cycle trend is the use of credit. That's simply.
Thanks, Tom. Yeah, I think my first loan was a student loan and my second was a car loan, which is maybe fairly typical. Also in the report, the task force explains the difference between APR and finance charge using what I thought was a great analogy, the analogy of unit price. Could you elaborate a little bit on what you mean by how an APR is the unit price and what the finance charge is? You gave some good examples in the report.
The price is the cost of anything, and the price is typically measured in dollars, but it's not the only way that we can look at prices or the only way that we can measure prices. So keep in mind that price is the amount in dollars, whereas an APR is really the price, the dollars, but simply divided up by units of time and units of dollars themselves. So an APR is a certain number of dollars per dollar borrowed per year. And so it's sort of like a unit price where you might go to the store and some element of food supply is offered for a certain number of dollars and cents, but then it's also indicated on the tag that it's a certain amount per ounce. Well, that's more analogous to the APR idea, where we're measuring it according to the basics of what's being purchased. Credit is a little bit different than purchasing something else because it has that element of time in it. But I think that thinking of the APR as a unit price is probably a good way of looking at it. Now, when Congress passed the Truth in Lending Act back in 1968, effective in 1969, it understood the difference between, it certainly appears that it well understood the difference between the price of something and the unit price of something. And so it required the disclosure of the finance charge in dollars, but then the amount per dollar per year. It's like other things that you might look at in the store, or bottles of fertilizer at the garden store, or liquid fertilizer at the garden store, or something like that, where it's a certain number of dollars, but then it's a certain number of dollars per ounce also, and it may not be the same for different sizes of bottles. Fertilizer, for instance, might get cheaper if you buy cheaper per ounce if you buy larger amounts, the same way that credit may get cheaper in terms of its unit price if you buy larger amounts or have it outstanding for longer periods of time. But the dollar, that's not the same as saying that the dollar amount changes or something like that. The dollar cost is disclosed and it's called the finance charge under Truth in Lending, but then the unit price, the amount per dollar borrowed per unit of time per year, is then known as the annual percentage rate, or the APR. In many cases, the finance charge may be the important number for people to look at, or the one that they find most useful for some types of credit. For other types of credit, they might find that the unit price is more interesting or more important or more useful. In particular, the unit price appears to be especially useful for amounts of credit that are different, or for periods of time that are different, and particularly for amounts of credit that are quite large. For smaller amounts of credit that are very immediate, for instance, the cost of a small loan for an emergency, research has shown that users of credit tend to find the finance charge, the dollar amount, to be the important amount. They tend to look less at the unit price, the annual percentage rate on the small dollar amounts of credit. Indications that small dollar credit users tend to look at the dollar finance charge.
So, Tom, you mentioned that consumers often look at the finance charge and may not be looking as much at the APR sometimes, particularly with small dollar credit. Did you find, or when you were reading past studies or conducting them in the past, do you find that generally consumers do understand small dollar credit, that they understand the product, what they're getting, their obligations?
Well, yeah, I think, again, doing research on questions like that is difficult because for academics, because it's inherently expensive to do. Yes, in general, I mean, even an armchair analysis without talking to anybody, it would seem that small dollar credit, that the finance charge would be more important, because we're talking about credit here that tends to be smaller in amount and for shorter periods of time, but the need is very immediate. In other words, it's an emergency, or a bill that otherwise is going to be difficult to pay, or simply a cutback in hours or something like that. In employment recently has led to a little bit smaller paycheck this month than had been planned. That the need then is very immediate. The cost of that bill that's missed in terms of late charges or other difficulties are fairly immediate and obvious, and it can be compared pretty easily to the amount of the finance charge also, since the loan is pretty short term. In other words, $50 for a loan of a certain size to solve this emergency is something that's easy to understand. On the other hand, something like the value of buying a house over 30 years and the amount of services that it's going to provide to you, and how that's related to the finance charge that's disclosed on a mortgage, and it is a required disclosure now, but those numbers can be very large, sometimes into six figures. It's hard for people, it would seem, just thinking about it from your armchair, to get their minds around, is buying this house going to be worth the finance charge of this magnitude over 30 years? It's just hard to think in those terms. With small dollars, it's much more obvious, much more immediate concern, much shorter, much smaller amount of money that's more readily comparable. So the surveys and the analysis that has been done in the past, looking at questions like this, have found that people do tend to know what they're doing. They understand the magnitudes of the amounts involved. They understand the needs because, again, they are immediate and obvious in most cases. And so I would say that that's what the research characterizes. That's what the research has found. That people do tend to know what they're doing on small dollar loans. Again, as I say, I hope that the CFPB and or somebody else continues to do research of this kind. I think the more information we have about it, the more comfortable we feel with that conclusion. But I think it's pretty well established now.
So building on that, I think we have time for one more question. Why does it cost more to make a small dollar loan than a large dollar loan?
Cost more? Well, it wouldn't really be possible. It wouldn't really be proper to say that it costs more to make a small dollar loan. It's just that it costs more per loan dollar to make a small loan. The reason for that is simply a lot of the cost of making a small loan is operating costs, and a lot of operating costs are fixed or close to fixed. So, for instance, a lender who's making small loans, or let's say a lender who's making any loans, typically needs an office and structure, needs accounting systems, it needs personnel, it needs communications. It may involve salaries, rent, acquisition of computer systems, legal talent, and so forth and so on. But when you think about it for a moment, you see that all of those costs are pretty close to fixed. If you're going to go into the lending business, that you're going to have those. But if you're making $100,000 mortgage loans, the amount of those fixed costs per loan dollar tend to loom small. Whereas for let's say $1,000 loan, those costs per loan dollar tend to loom large. And so operating costs simply are larger per loan dollar on small loans. And we see that people will not make small loans unless they can get an APR rate, unit rate, high enough to be able to cover those fixed costs. So, I mean, think of it this way, that the cost of making a $50,000 loan are probably higher than the cost of making a $1,000 loan, but they're not going to be 50 times as high. And so the cost per loan dollar then simply are higher on smaller loans. And so the rate has to be higher on smaller loans. The task force did consider this at some length, basing its discussion on just what I've said, but it also has numbers and graphs and things like that are probably worth looking at for anybody who wants to look at this a little bit more closely.
Well, Tom, I think we're out of time for the podcast today, but I do want to emphasize what you just said. I highly recommend that everybody look at this report more closely. And the report is written in such a neat way that if you just pick it up and read one chapter, you can read it because that chapter will incorporate what's needed from the chapter before and go into what's happening in the next one. But
I certainly recommend the exciting nature of the whole report.
Well, I found it fascinating to read, and I hope that everybody listening picks it up. And with that, thank you very much. We really appreciate you joining us today.
Very welcome. It's been my pleasure.
AFSA hopes you've enjoyed this edition of the Extra Credit Podcast. Don't forget to follow AFSA on Twitter at AFSA_DC and on LinkedIn. Just search for the American Financial Services Association. You can also follow AFSA's SGA team on Twitter at AFSA_SGA. The blog at AFSAonline.org is also a great resource for the most up-to-date news. If you've got questions or if you'd like to suggest a guest, please shoot us an email at communications@afsamail.org or tweet at us. Join us next time for more Extra Credit. Thanks for listening.